Okie dokie. Okie dokie, everyone. First of all, a very good day to every single one of you. And can I start off by saying either a good morning or good afternoon or good evening or even a good night, depending on where you are around the world. So please, thank you for taking the time out to spend some time with me on tonight's episode of the webinar series I call Discover. And tonight's episode is Discover Elliott Waves, written by yourself, James Alexander, who's the market analyst here at Wise Bank. Now, before we get onto the agenda, just give you a little bit of background information on myself. Like I say, my name is James Alexander. I'm the chief market analyst here at Wise Bank. I have over 20 years experience in the financial service industry. I actually started out in mortgages, and I specialized there in commercial mortgages, buy-to-let investment, and other types of commercial real estate deals before moving into pensions and alternative investments. I got into trading around about 12 to 13 years ago, and I have indeed traded myself for many, many years. I actually traded for a prop company, trading through the Dubai Gold and Commodity Exchange when I was based in Dubai, and I specialized in gold option trading before moving into several other stocks and shares where I ran several sales floors around the world. Then I went into portfolio management before moving into education, like I'm here right now talking to you good people. I'm indeed a published writer, and I've had several articles published in leading publications, including the likes of the Financial Times Advisor, Market Watch, The Street, City M newspapers, just name just a few. And I'm extremely passionate about the marketplace, and I'm indeed an avid market commentator. As well as that, because I like the sound of my own voice, and as you can tell, I'm British, so don't hold that against me, I have also spoken at several events around the world, including the likes of Singapore, Dubai, Berlin, London, and more recently South Africa, where I spoke at Joburg, Durban, and Pretoria. Now, like I say, I've been writing the Discover series for several weeks now, and tonight's episode, like I say, we're going to focus a little bit on Elliott waves, okay, which I find is a very fascinating theory, and once you get the gist of it and an understanding of it, you have a chance of potentially recognizing, where the market may go. But let's discuss a little bit more about this. Anyway, tonight's agenda, we're going to discuss what is the Elliott wave theory. Then we're going to discuss what is impulse waves. Then we're going to talk about what is corrective waves. Then we're going to discuss the rules of the Elliott wave theory. Then we're going to go for a few examples, live examples, as examples I've actually taken today, so we can see it actually in action, before talking about November schedule and obviously the usual question and answer session. So if you have any questions related to what I'm talking about tonight, please feel free to ask me at the end of this webinar. So, what is the Elliott wave theory? The Elliott wave theory was actually developed in the 1920s by surprise, prepare yourself, by a man called Ralph Nelson Elliott. That's one thing about technical analysis. Whenever they come up with theories, they're very imaginative with their titles, and they usually base it on a man or a person who invented it. So in this case, Ralph Nelson Elliott came up with this theory. Now, the theory is based upon the belief that stock market is driven actually by repetitive cycles and is not actually by chaos. Elliott believed that these market cycles were created by traders reacting to the psychological effect of the masses. These upward or downward movements in the market, which he called waves, hence the title Elliott wave theory, he believed you could recognize these waves, and if you could recognize these waves, then you could possibly predict where the market may go next. So these so-called waves can actually be split into two categories. One category is called impulse waves. And the second category is called corrective waves. Now, impulse waves. Elliot proposed that a market that was in a trend would move in a 5-3 wave pattern. The first 5 waves in this pattern was called impulse waves. In this pattern, wave 1, wave 3, and wave 5 would go where the overall trend of the market was heading. But wave 2 and 4 were corrective. What does that mean, James? Well, I will explain. So this is the theory. That's wave 1. Wave 2 would look like that. Wave 3 would look like that. Wave 4 would be the corrective wave. And wave 5 would be like that. So wave 1. What's happening during wave 1? Wave 1 is when the market initially moves upwards or downwards. It could also be downwards. Moves upwards, okay, for the sake of this explanation. This is driven by a small number of people buying in on an asset because they believe the price is low and they think it's the ideal time to buy, moving the wave upwards. This obviously causes the price to rise. So this is wave 1. Wave 2 is when enough people have bought in to that asset, now consider it overvalued and start to take profit, selling it off, which causes the price to drop before the market sees it as an ideal price and start to buy in again. So that's wave 2. Wave 3 is the longest and strongest wave. The asset has now caught the imagination of a great deal number of people, and this causes the price to start to surge. Wave 3 usually exceeds the first high hit by wave 1. So this longer wave is wave 3. Wave 4, at this stage, traders lock in their profits as they now consider the asset to be too expensive. And this causes the price to drop again, but it's a weak sell-off as there's still a good number of bulls in the market. So this is wave 4. Finally, you get wave 5. Now, wave 5 is driven by hysteria as the last number of bulls rush into the market based not on what they think the intrinsic value of the asset is, but based on the fear of missing out. Wave 5 usually is the time when you start seeing the asset talked in like the normal newspapers, not the market newspapers, but like you're talking about the daily tabloids. You're seeing it on the normal news, not Bloomberg, but the normal news. It's in the headlines. CEOs of that asset are constantly on the front covers or something, because all of a sudden, it's the mass hysteria that they've seen in this rise and people start to rush in and it pushes the price higher once again. But this time, like I say, is not driven based on analysis, is driven by the last few people who wants to get a piece of the action, so to speak, and pushes the price up finally till this really is overpriced and it becomes to the next session, the next wave. Oops. So this is the wave 5 at the end. Here, the final bit of the masses rush in. And this is when we prepare ourselves, when we see wave 5, we see the hysteria taking control. This is when we wait for the corrective waves, but also known as the ABC pattern. And this is the ABC pattern. Before we get to the ABC pattern, though, let's just talk about the 3 rules of impulse waves with Elliott wave theory. Rule number 1. Wave 3 should never be the shortest impulse wave. It's always got to be the longest wave. Rule number one. Rule number two. Wave two should never fall beyond the start of wave one. Rule number three. Wave four should never go to the same level as wave one. So it should never drop back to where wave one started from or ended from. So let's have some examples, okay? Let's have some examples. Here is the example of WTI oil on a daily. Again, I've taken this today. The ABC corrective waves, so you know, you tend to see, and I'll go through this on a live chart to show you what the corrective waves are all about, because this is when the ABC pattern forms after wave 5, and I'll explain it to you here with a chart now. So this is oil on a daily. Looks to me like most people can see it as a normal chart, but let's have a look and see if we can identify a pattern or the Elliott wave in action. Okay, wave 1. The market starts to buy in, initial people jumps in and starts to move the asset higher. Wave 2, those initial people who've bought in on the market sell off and start to take a profit. Wave 2. Remember the notice, let me get my little pen, laser pointer, here we go. Remember the rule, wave 2 should never fall below where wave 1 started. Wave 2 jumps in and starts to sell off. Then it really starts to capture the imagination of the masses and skyrockets. Wave 3. As you can see, it's the longest. Don't forget, this is a daily. So every candle is a day. So this is the longest wave, wave 3. This point, wave 3, enough people start to sell off. Okay. And start to lock in their profit, causing wave 4. Wave 4. Finally, the last few people that got hysteria, started reading the oil, in this case was WTI oil we're talking about, was at monthly highs, rush into the market and push the price higher, making it wave 5. This is where we then see the corrective wave, the ABC pattern. Because what happens with the ABC pattern, first of all, because the wave 5 has pushed it to an overpriced level, the market starts to sell off, forming wave A, the corrective wave. Wave A stops, and there's still enough bulls in the market to buy in. So they jump in and start to buy in, causing the corrective wave, wave B, where it pushes the asset up a little bit higher, making wave B. But by this point, because of the big sell-off, because wave 5, the impulse waves are finished, there isn't enough bulls in the market to carry the price up higher. So what happens is wave C starts and the market really starts to sell off, meaning that impulse wave is finally over, causing wave C. So A, B, C is the corrective waves. And that's when, again, the Elliott wave pattern is finished, and we then start to look for another pattern. What do you mean by that, James? Okay, let me show you another example. This here is the euro dollar. Now, like I say, though I've been talking about this presentation as a euro dollar as looking for an asset on the move higher, Elliott wave theory can also move if something is on a downtrend, because it's all to do with a downtrend. Remember what I said at the beginning of the presentation? Wave 1, wave 3, and wave 5 follows the trend. Wave 2 and wave 4 are corrective waves, which goes against the trend for a small time being. So the Elliott wave theory also operates if an asset is falling, and this is a great example of an Elliott wave pattern, again on the euro dollar daily. So wave 1, the market starts to sell off. Those who have sold off have gone short, lock in their profit, causing wave 2, a corrective wave, market to move back up again. But by this point, beginning of wave 2 or the end of wave 2, the market has got really excited. The mass number of people have started paying attention, start jumping in, start shorting, in this case, the asset, the euro dollar, causing wave 3. Remember the rule. Wave 2 should never start or end where wave 1 started, and wave 3 should always be the longest wave by far. So wave 3, the big market sells off and a great big drop. Don't forget, this is a daily, so every candle represents a trading session, a daily trading session. Hits the bottom of wave 3. Wave 4 jumps in. Few people, as they've taken their profits, sell off. So they sell to buyers who buy in, making wave 4. But the last ditch people still jump in, believing that they obviously their fear of missing out, push the asset back downwards, selling off, creating wave 5. And at the end of wave 5, then we look for the ABC pattern. Slight recovery, corrective, people buy in, people sell off, wave B, and then people buy in again, wave C. Now, the theory behind this, of course, is if you could start to recognize, say, these patterns, then you could possibly recognize what's going to happen next. And let's have a look here. So we've got the end of wave C. Don't forget, this is a chart I've taken recently. I did this chart today. Okay, because usually what people look for after the corrective waves, whether they can see the beginning of another Elliott wave pattern, whether they can see if the market's going to range, or whether they can see if the Elliott wave pattern, the 5 impulse waves, are about to start again, and then they could possibly jump in to take advantage of it. Really what people are looking for ideally is when wave 3 is on its way. So they can jump in at wave 3 and follow, on this case, in the euro dollar example, the downward pattern, or if it's an uptrend, the upward pattern. So let me show you the example here. There we go. Here we go. Look here. Here's wave C. So we're looking for the next potential Elliott wave or next impulse waves. And this is the chart afterwards. The question is, we need to watch this more. Again, I'm not telling you this is definitely the case, but this is what I'm looking at now to see if I can see the pattern forming right now. If this is the case, that after the corrective wave of wave C, that I'm looking at as potentially could be wave 1, maybe it is. Then we have wave 2, maybe it is. Then this could be the beginning of the new wave 3. Not saying it is, I'm just saying at the moment, this is what I'm keeping my eye on. And this is why we try and understand Elliott waves, is try and identify where the next either corrective pattern might start or the next 5 impulse waves might start, on what potential wave we are on. Now, other educational events coming up. We have an event coming up, obviously a brand new schedule in November. Brand new for the Discover series. It's coming very soon. I'm going to be releasing it on Monday, the new schedule, obviously for Wise Bank. Some of the subjects I will cover for Wise Bank next month will be, obviously we're doing a few more case studies on some assets, which you good people have asked me to actually do. So I'll be doing some coverage on assets in next month. Also going on a little bit of portfolio management and hedging techniques. So that will be hopefully really useful. So anyway, by Monday next week, you'll have the new schedule for the new Discover trading schedule for November. If you wish to contact me, by all means, you can indeed email me at james.t@wisebank.com, or I've just as of yesterday released a Twitter account, okay, which is my handles is at James Alexander T. T is my middle name, which you can follow me on. And my Twitter, I do about 5 to maybe 7 posts a day, and I do share with you or with my followers what I'm seeing in the market, potential levels to watch, and also at the same time give you an idea of what's happening in the market on a daily basis. You know, I do share with you charts, patterns, and levels of support and resistance I could potentially see. You know, so I share you what I'm seeing, and so you can take on that board and do that what whatever you wish to do with that. So follow me on Twitter. Just started it yesterday, so hopefully it will build up momentum. So please feel free to follow me. But at the same time, you can also direct message me on that as well if you have any questions or if indeed you wish to speak to me. On that note, it's a short presentation today because I like to keep it short and sweet, because otherwise there's a lot more information for you to take in all at once and it can be a bit too much. Plus, with Elliott waves, there's such a huge thing to go into. So I will do part 2 about Elliott waves a little later, so we can then discuss, obviously moving on to the different chart patterns after the Elliott wave. But saying that, is there any questions, anything, anybody you'd like to ask me about tonight's webinar at all? Any questions at all? Don't be shy. Honestly, I won't bite, I promise. Okay, did everybody at least enjoy it? Did you find it useful? Did you like it? Did you find it insightful? Or are you just basically sick of my voice at this point? Did you enjoy it at least? Either yes, no, not really. It was okay. Find it, I'm sick of his British accent. James bores me. Did you find it useful? Because look, here's the thing about Elliott waves, okay? Once you can start identifying it, you can see the theory behind it. Because let's face it, realistically, this market really is driven by the amount of people buying and the amount of people selling. The amount of people who feel bullish about something and the amount of people feeling bearish. This is what drives the market. Because if you don't have buyers and sellers, then obviously the market is not going to be really moving. It's relying on these people who are buying and selling. That's the crutch, and that's the secret behind it. Okay, I got one question here from Bob. Actually, not a question. No, it's a Bob that said, I really enjoyed it. Look forward to part 2. Okay, is there any subject in particular, Bob, you'd like me to cover in the future, maybe? Oscillators. Okay, you use oscillators at the moment, yeah? Okay, I'll do a webinar on oscillators. No problem. That I will do. Right, if there's no other questions or anything else, can I just say thank you, every single one of you, for joining me tonight. And can I then say either a very good morning, or a very good afternoon, or a very good evening, or a very good night, depending on where you are around the world. Till next time, every single one of you, trade safe.